My whole thing is, one thing I hear a lot of the times when it comes to anybody in real estate is, I don't have the money or the credit or the time or the intellectual property. And I said, okay, no problem. I have the money, have the credit, have the relationships. I'll teach you how to locate a good deal, right? Buy below wholesale.
I love that.
And once I teach you that, right, I'll bring me the deal. I help you underwrite the deal, which is fine. I'll even fund the transaction for you as well. So there's no excuses on the table at all. That's why we call that the cash flow club. Period. So what happens is people always ask me all the time, Dale, can you train me? Well, I don't have the time to do that. But what if I set up a platform for it to where you get on-demand training? Anytime you want to, because the training you may need may be after you get off work, early in the morning, during the day. You just log into your account and get the same training as if I'm sitting there one-on-one. We're talking about our attorneys, our general contractors, our appraisers, as well as me, talking about how to structure your business, how to put together what they call a power team. A power team is very important. How to put a deal together, right, and buy it at the right price point. How to market. There's one technique that people don't understand, that you can actually get a list of properties that from your city for free.
Whoa. So walk me through that. Like, you can physically get buildings or homes or properties available for free?
Yeah, I'll send you guys the bill in the mail. It's real simple. What you can do is you can actually call down to your city and ask for the violations division. What happens is you say, hey, I want to see what homes in our city actually have violations. What are violations? High grass, no paint, vacant. You have boards on there. Those are actually violations that the city, or citation that the city has actually levied against that property. They'll give you that list for free. It may be a little bit of a fee, maybe $100.
Sure.
But it is what it is. Then what you do is you actually can contact those sellers of those properties one-on-one.
Wow, and that's how you make your money. That's one way. That's one way.
If you'd like to learn how successful real estate investors make money when they acquire real estate and not when they sell it, click on the link below, swipe up, DM me the word to real estate to download our free ebook, Distressed Property Investing. The blueprint is in the ebook. Stay blessed. I'll let your partner and download the ebook today.
Sir, there's a GC right there, Cliff.
Go.
It's piers. We got concrete piers and wood piers.
Yes, sir.
Checklist. Let's check out the checklist. We got it for everything we need.
Yes, sir.
You forget some things sometimes. So this is going to outline, make sure you hit every single thing. What's the foundation, plumbing, electric, painting, flooring, everything. So you don't miss anything.
Okay.
You want to make sure you get all your checks.
Okay. I want to introduce you guys to Cliff Hunter. Cliff is a world-renowned flipper. He actually flips. He's also a GC as well. He's a good contractor. When it comes to all of our renovations, all over the nation, you'll talk to this guy right here. What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, y'all? It's your partner Dale back in the saddle again for another edition of the Investor Edge podcast. It's just gonna be me today, guys. Cliff is taking care of his dog, guys. His dog had a little bit of an accident, and he had to take it to the hospital, man. So be praying for him and his dog. He has a I think a pit bull, big old thing, man, big old thing. It could bark his behind off, but he got hurt doing something he shouldn't be doing. And so Cliff is take care of him, man. So be praying for him and his dog, man. If you could, guys, do me a favor, like, share, and subscribe, guys. If no matter what platform that you're on, and if there's a bell there, do me a quick favor, click on that bell. So when Cliff and I come live every Friday at 5 p.m. CST, between that time frame, you come kick it with us, man, and sit down and talk a little bit, man. And we are setting something up, man, to where we may have a call-in line or allow for you guys to come on the screen with us and ask questions about real estate investing and private equity financing and cryptocurrency, guys. That's a big pivot that we're talking about now. That we see a big pivot there. So if you could, guys, like, share, and subscribe. That helps us out when it comes to the algorithm, guys. All right, if you don't mind, do me a favor. Now, here's what we're talking about. We're talking about a couple things here real fast, guys. Number one, man, we have a new Fed chairman. Kevin Warsh is his name. Well, he had his first rate either cut, remaining the same, or rising type of press conference. What did he say in that thing? We'll talk about that. His first is number two, why the new Fed chair may see more rate hikes ahead. Ooh-wee. And then number three, guys, we're going to talk about a technique called the BRRRR Method, which is buy, rehab, rent, refinance, and repeat. Okay, it's called the BRRRR Method. It's a very popular technique. I've used it several times. It does work. We're gonna dive into that, and I may walk through a specific property that we actually did it with, just the numbers on the thing, so you can see exactly what's going on and see how it works. And I may introduce you guys to, I think, one of the best trainers of this method, I think, on social media, period, and it's not me. Okay. All right, guys. Let's dive into the first topic, man. The first topic we're going to talk about real quickly is, hey, man, the Fed chairman made his first decision. All right. Right. We're talking about rates unchanged, inflation concerns, and economic growth outlook. So let's dive in real quickly, guys, and see what actually happened when the new Fed chairman made his first decision with the governors of the Fed concerning the rate changes. Here is a little video of him talking about this, man, and we're going to here we go. Let's dive into this thing one-on-one. Let's get it in.
From the Federal Reserve announcing its latest decision on interest rates. Now, the announcement is the culmination of the first policy meeting overseen by new chairman Kevin Warsh, who succeeded Jerome Powell. Warsh is expected to make remarks about today's decision later this afternoon. The board is expected to leave rates at current levels. Remember, inflation is surging to its highest level in more than 3 years, and lingering uncertainty in Iran. And we did just get the decision that interest rates are unchanged. So let's go to CBS News Money Watch correspondent and Saturday morning co-host Kelly O'Grady, live from the New York Stock Exchange. Kelly, you were reporting this all day yesterday, all day today, that you would have been shocked if there was anything other than no cut. Remind us of the conditions that support that right now.
Yeah, I know. I wish I were a betting person, Lindsay, because my prediction turned out to be true. So look, the idea behind this is you have a labor market that has been doing quite well, you know, multiple months of job growth over 100,000, but you have inflation at a 3-year high. We've seen prices continue to go up at a faster rate than towards the beginning of the year, with energy prices up with the war in Iran. And I'm just looking through this statement right now. It's actually quite short, which is a pretty big departure from what we have seen in the past. Normally it's sort of a 2-page statement. This is less than a page. And they specifically call out the conflict in the Middle East. They say economic activity is expanding at a solid pace. That's a nod to the job growth, despite elevated uncertainty that owes in part to the conflict in the Middle East. Productivity growth, capital investment are strong. Job gains have kept pace with the workforce. Unemployment rate has changed little. So it seems like, as we talked about yesterday, that they decided to keep rates the same because, look, things are going well in the economy at that top line level. But then you have this price growth. And so they wouldn't want to cut interest rates because that could spur demand and price growth go up. You want to really focus on that right now until there's more clarity with what is happening in Iran.
Last night you told me that really the headlines are going to come from his remarks and his tone. What will you be listening for?
Absolutely, because this is the beginning of the Warsh era, right? my entire career reporting on business has been in the Powell era, and so I'm really going to be listening for. Is he bullish on cutting interest rates?
Okay.
Is he more data dependent? What kind of language is he using? You'll also likely hear Warsh get asked about what was the tone in the room. Are there people that are advocating for a rate hike if we see inflation stay where it is or go up? That has been something that's talked about by a lot of economists in this year with what is happening in Iran, that you could see a rate hike by the end of the year. Obviously, those things can change very quickly, but I'm really curious how he addresses some of those questions about the tone in the room over the past 2 days that the Fed has been meeting. And of course, also, what does he say to questions about the president wanting to lower interest rates? What we have heard from Warsh thus far during his confirmation hearings is that he thinks that the Fed talks too much.
Oh, wow.
If you actually go back a couple of decades, there wasn't a press conference every time there was an interest rate decision. And he has said, I actually think the Fed shouldn't be making much statements about the future at all unless they have something meaningful to say. So we could hear a tone shift from him today on also how much the Fed plans to communicate in the future.
So guys, it is very clear to see that the new Fed chairman is operating a little bit differently than Fed chairman, former Fed chairman Powell. Fed chairman Powell has been very in the past open and vocal. He had each time there was a rate change, there was a press conference all the time. He really was loved, in my opinion, being in front of the camera. And to me, that was too much. That's just me. But at the exact same time, that's what he wanted to do. Now, Warsh is different. I'm not surprised at all that they decided to keep the rates the same. He's been in office for a little bit, I think a little less than a month, or a little bit over a month. So, with that being stated, I think that he wants to see a little bit more data, which is fine. Now, they did point to the Iran conflict concerning keeping it the same. So they're basically saying what's happening overseas is affecting what's happening here domestically. And that's interesting. And I got to kind of agree. If you look at the gas prices, although they've been coming down a little bit more, the conflict over there, specifically around that Strait of Hormuz, that's where a lot of the oil traffic was going through. And you begin to see a lot of uptick in the cost of oil, right? But as soon as I guess the deal was actually struck, you begin to see a lot of oil tankers, well, other countries coming over to the U.S. to buy more oil. So I'm not surprised at all that this rate unchanged. Now, what's this mean for real estate market? It means it means that it's going to remain the exact same, stagnant. It will not change. Unfortunately, it will not change at all. Period. I think rates are 6.25, 6.5. I may be a little bit off, but it's in the 6 range. FHA, the VA type of scenario. You see a lot of sellers right now giving a lot of concessions. Some are a bit stubborn because they actually want their price point. But typically, those type of sellers either have no debt on the property or they don't want to pay the capital gains right now, or they owe debt on the property. So and they're comfortable with paying 1 or 2 mortgages, right? So again, I'm not surprised about this at all. I expected a non-change on this rate. I would have been very surprised if they came out right out of the gate talk about a rate cut. But if there was a rate cut, I expect maybe a 1/4 point, which is nothing. It's nothing. So get ready, guys. In my opinion, the market is going to stay stagnant for a bit, guys. I believe by next year, you may see some movement. But I believe throughout this entirety of this year and even next year, you're going to see a stagnant economy. It is. So, but what does that mean for you as an investor? Opportunity, because Our next topic here in a second, guys, you're going to see why I say opportunity, guys. Let's go to our second topic. Our second topic here, guys, is going to be, man, pivoting over here, why Fed Chairman Walsh may see more rate hikes ahead. Rate hikes ahead. And why Wall Street is paying attention. Let's dive into this topic, man. This right here interested me because of the fact that I wasn't, there was a chance that I thought there was going to be a rate hike, guys, right, in the future. But he said it in his, his confirmation hearings about maybe a rate cut a little bit. But again, don't know. But let's see what CNBC has to say. Let's get into it. Here we go.
We have a new chair in Kevin Warsh, and he came in and put his imprint on things very quickly.
It's an honor, a true honor to be back at the Federal Reserve.
We're in a holding pattern as far as rates go, but there is a strong inclination from the committee that the next move could be higher, which of course is counter to a lot of the things that Kevin Warsh had talked about as Fed chair candidate Warsh. His focus was much more squarely on the inflation side of the Fed mandate. They, of course, raised considerably their outlook for inflation this year. The last meeting in March, they'd been looking for inflation around the 2.7% mark, expecting somewhat.
Now, we have a question on real fast, guys. Let's apologize real quickly on TikTok. Good to see you guys. It says, why won't they lower interest rates? Tony A611, good question. The reason why they won't lower interest rates is because of the fact that you're dealing with an inflation problem. Each administration, how they calculate the interest rate, the inflation rate, is really kind of, they pick and choose what to include and what not to include. Right now, the market is stating that a rate cut doesn't make any sense. Now, if there is a rate cut, you're probably going to look, Tony, as a very small rate cut, a quarter of a point. That's nothing. That's nothing. A big rate cut would be half point to a point, right? And so they kind of said in what they were saying that they were concerned about what's going on in Iran. We have a deal somewhat in place. We'll see. And you begin to see kind of the gas of the oil come down. We're going to see how that goes. But they pointed directly to the Iran conflict. So what they're saying is, hey, what's happening on international waters is affecting the domestic economic turns here. And they're right. They're right. And so what they're taking that data into place because there's enough data there, right, to make that assumption. So this is not a projection of information. They're saying we're seeing 100 days of this. And so that's more than 90 days. So with that being stated, we got to factor that into either a rate cut or unchanged. Right? Now, here is what I want to say about this, guys. This is talking about how he may be foreseeing a rate hike. Rate hike. Okay, and I'm going to dive into that in a second. Here we go.
Much slower growth than had been projected before. He did use the Iran war as basically the fall guy for the inflation issues we've been having.
Economic activity is expanding at a solid pace, despite elevated uncertainty that owes in part to the conflict in the Middle East.
He didn't really provide any guidance in terms of when he expected that to abate. What I was struck by from Warsh, almost more than anything at the press conference, was a real shift in tone. Candidate Warsh had talked about regime change at the Fed. Today, he was talking about how incredibly impressed he was by the type of dialogue they had there.
We'll be meeting again in 6 weeks. I think we're going to know more then. And I think that my colleagues are very attentive to incoming developments between now and then.
So again, he kind of hinted toward maybe a rate hike. And I'm going to point toward the Iran situation because what I'm hearing from him is, and he said it out of his mouth, as you guys heard, he was really concerned about the Iran conflict. And I got to say that it does have a direct effect on our domestic business. It does. Look at your gas prices. Look at your gas prices. And some food pricing as well is hiked up because of the fact that a lot of petroleum is behind the pricing of food and other industries, guys. Like, we got to be honest here about this. So there's supposed to be some type of signing ceremony, I believe, next week between the Trump administration and the Iranian leadership up there. So we said to go for they're signing an MOU. Trump even said that he's probably going to have a press conference, going to read it word for word, because people want to see what was actually in it, right? And so we're going to see what actually happens there. But I kind of agree with him, right? But let me kind of preface this, guys. A rate hike. Is there a chance for a rate hike? The answer is yes. Let me tell you why. Okay? The reason why is this here, guys, is this is a MOU. I'm going to use Iran as the foundation here. This is an MOU, which is different than an agreement. Okay? Right? So, an MOU is a memorandum of understanding. That's all that means. And it sets out parameters for each side to actually meet to get to an agreement. And the time frame there is 60 days. 60 days, right? So the time frame is 60 days, guys. And let's say, for instance, hypothetically, they do not come to a deal, right? Then what? Trump already said there's going to be some bombing. We're bombing over there again. What happens to gas prices? They go up again, right? Because there's a conflict between the Strait of Hormuz right there. It's real simple, not hard. This is the reason why there's possibly a rate hike. And number two, guys, the government has been doing some excessive printing, guys. This is just ridiculous. The Democrats want the renewals of the ACA stuff. It may have already been done, and there are subsidies for that. That's just more printing. You have the budget. They keep on increasing the debt limit, guys, the debt ceiling. They cannot stop printing. It's impossible. This is the reasoning why, guys, right? I'm going to go there in a second. But there's the reason why, guys, when Trump got in office, the first initiative he began to push as far as legislation was the Genius Act, which is the Bitcoin and cryptocurrency legislation that was signed into law. Number two, which was intertwined in the Genius Act, was the Clarity Act. This was so profound that the banking industry, what they did, they invested hundreds of millions of dollars to lobby the Senate to not passing this out of committee. It passed the House with flying colors, right? It just came out of the Senate Budgetary Committee, and it's now going to go to the floor for voting. If it passes the Senate, Trump's going to sign it into law. And what that does is that kind of indirectly deregulates the banking system. This is why I've been talking about digital banking or fintech digital banking, right? Because here is the play. I would not be surprised if the Fed raises the rates. The reason why is because the goal of the government is to inflate the debt away. They do not we don't have enough revenue to come in to pay for this, guys. Guys, if you go to debtclock.org, again, debtclock.org, you can see a live counting of the debt, guys. They said that we have $39 trillion in debt. No, we don't. We actually have $200+ trillion in debt, right? That's number one, because why? Medicare, Medicaid, and Social Security is not in that $39 trillion figure. Those are liabilities on our balance sheet, guys. Why do you think they've been saying that Social Security is going to be coming solved between 2030 and 2035? Why? Because the government's been printing so much damn money. So what do? Is Mark Marsh talked about this on my podcast yesterday. I talked about this yesterday on the podcast. Go relook at it, guys. This is how they inflated. They did this in the 1940s. This is the 1940. as well. They ain't inflate the debt away. What happens is that this wounds those that actually hold T-bills and government bonds. It wounds those. Why? Because it debases the valuation of those two assets, so to speak, because those assets rest upon the dollar. So what actually happens, guys? Check this in the hard. This is not hard. This is simple information. They cannot pay this off. We have, I think, $5.4 trillion coming in revenue tax-wise, 7.1 going out in debt payments. That's like over $1 trillion in arrears per month. We cannot pay down this debt. We cannot at all. The only option on the table is to inflate the debt away. We got a question also, or a statement also on YouTube. It says, I wonder how high will it go? Will we reach past 8%? Great question. Great question. Let me think about that. Will we meet 8%? In my opinion, right now, I don't see past 8% right now. I don't. Now, I will say, give me the leeway to kind of be able to pivot later on and see some more data, right? It really depends about how they implement this Genius Act, because that was a powerful legislation that they actually passed, guys. It was so powerful. What it did, it actually had the finance minister of Russia, which is the same as far as title and level in government as our Secretary of Treasury. He said the U.S. government is trying to inflate the debt away. They are. They're trying to inflate the debt away. They are. So will it be 8%, guys? Ooh. I'm assuming you're meaning prime plus 2%, because right now to get a mortgage is 6.25%, which means it's 4. The Fed rate is probably at 4.25. So that means they have to go up to 6.25. I gotta say, man, that may happen. That it probably happened though, probably after the midterms, because no president really wants to go into the second part of the term with the economy being the way it is. We have to see. We got to see. But I wouldn't be surprised if it does. Not at all, guys. Not at all. Man, this, woo. All right, guys. Let's go to our last topic, guys. And I think you guys are going to like this topic, man, real quickly. Our last topic, real fast, is, man, the BRRRR Method explained. This is one of the most popular methods, right, guys, in real estate. Stands for buy, rehab, rent, refinance, and repeat. That's the BRRRR Method. It is a way that people have made a lot of money in real estate and pay little to no taxes at the exact same time, keeping themselves capitalized very well while leveraging the debt properly with the proper leverage, right? We're going to talk about this for a brief second. I'm going to give you my term. Now we got to look. It says, he said, I'm getting up to buy again late 2026, going to 2027. So that's why I want to, yes, I would say if you're looking to buy right now, guys, pay attention to this segment, okay? Because when there is high inflation, or the inflation rate may be going higher, I tell you this here right now, that is the best time to buy, because you get so many deals, and you make your money when you buy, not when you sell. Okay, now what I'm going to do is I'm going to bring in someone that's on the tax side of this, and then I'll give my comments as well. My man Alonzo, what's up, Alonzo? You said I've got a private reserve BRRRR method I teach. Oh, cool, man. Good stuff, man. Good stuff. BRRRR method is cool. I like it. I do utilize it. It can be utilized with land properly. New construction. Well, I'm gonna say so much with land. Sorry. It can be with new construction, a renovation of SFRs, or multifamily renovation. But the secret is buying the right way. You have to buy at the right price point. You have to. All right. So let's bring my partner real fast, man. Let's see where you go to. Where's he at? This is Carlton Dennis, guys. Carlton Dennis. He actually is a trained tax strategist. That's what he does. All right. So I like to bring in people that are not me to explain this in a little bit more robust platform. Let's get into it. Let's go.
Step number one is buy. Everything starts with buying the right property. This is easily one of the most important steps in the entire process because your profit is largely determined at the moment you purchase the deal. The goal here is not to find a perfect move-in ready home. Instead, you are looking for a property that needs some level of improvement. A good BRRRR property typically sits somewhere in the middle. It should not be fully renovated because that leaves little room to add value. And at the same time, it should not be in such poor condition that it requires a complete tear down or extremely expensive structural work. The ideal property is one that needs
that part I disagree with. Okay? That part I disagree with. All right? I know what he's talking about here. How he said, let's go back to it real quickly, what he actually said. I want to make sure that I'm accurate because Carlson, he's a brilliant guy.
And at the same time, it should not be in such poor condition that it requires a complete tear down or extremely expensive structural work. The ideal property.
So he thinks the ideal property is one of these cosmetic work. I disagree. I've made the majority of my money, guys, with properties that they actually need a lot of renovation because of the fact that, number one, I know how to renovate, and number two, you get it for a deeper price point. Now, if you can get a cosmetic property at the right price point, yes, not a problem. If that's the context, I'm rocking with you. But for me, the more work that I see, and it really depends in the geographical area as well. But the more work that I see, the aggressive I am on the purchase price. Because I know if I can get it at the right price point, I can make an immense amount of return there. Right? Here we go. Let's get this guy and dive into it.
Is one that needs cosmetic upgrades or moderate repairs, such as new flooring, new paint, updated kitchens, updated bathrooms, or general improvements that will significantly increase its value. Finding these types of deals will take effort. While some properties can be found on popular listing websites like Zillow or Redfin, many of these best opportunities come from less competitive sources. Investors often explore foreclosure auctions. They work with wholesalers, or they pursue off-market deals directly with property owners. But the key idea is simple. Buy at a price that leaves room for profit after renovations. Now, location still matters.
Now, he's right, guys. He's right about that. Location is cool, but buy at the right price point. That's profit after the renovation. Can I give you guys a little bit of a secret here, right? And I learned this from a guy really on Instagram. I was kind of doing it, but he actually made it. He kind of counseled me on how to make it even more robust, right? From a profit standpoint. Okay. What you want to do is when you're doing a renovation budget, guys, what I simply do is this here is I make sure there's enough margin in the renovation budget to where I take home from the renovation budget. Because you own the property, you're responsible for the debt, so you are the master GC. You have a general contractor that actually heads over the renovation, but you are the master general contractor because everything begins and ends with you. So if my renovation costs X, I want to make sure I have at least 5 to 10% of a delta there to take home out of the renovation budget. That pays me, right? That pays me because I'm investing my time into this project. So therefore, I should be compensated for my time. No one likes to work for free if they don't have to, right? If there's a benefit of working for free, do it. But if you don't have to, don't do it. Specifically, if you hold the keys to the kingdom. So I agree with that, but a little bit of a secret: put your fee in your scope of work so that you get paid in the draw process. What is a draw? A draw is when you borrow the capital to renovate the property itself, right? Typically with a draw, it works in two ways. Number one, you front the first draw, which is typically like maybe 10, 15% of it, right? And what happens is once the work is completed, you ask for a draw request from your bank and the bank gives you that money back, right? So it's kind of boom, you outlay cash, get it right back. Outlay cash, get it right back. That's how that works. Or, which is what I like, I actually asked my bank to front me that first draw because I bought the property and also brought the down payment to the table and closing costs. So I need reprieve. So I normally ask my banker for that first draw. Will they say yes all the time? No. But I push for it. But again, I make sure there's probably a 5 to 10% delta in there. It's going to work for me to make that master GC profit. Okay? Let me give you an example. We had a property that we did in Florida, renovation. And it was a huge renovation, $600,000 worth of renovation, right? Well, we were able to do this here. We were able to bring that $600,000 down to 50% of that. Yes. We got, about 60%. We got the whole project done for about $400,000. I'm rounded up. But we had earmarked in a draw process for $600,000. So what's 400? What's 650? What's $600,000? 600,000 minus 400,000. $200,000. That was my master GC fee. Do you see how you can make that work, guys? That's a master GC fee. I put my fee in the scope of work. Okay? Now you can't just come out master GC fee. No. You have to make sure that it's labeled the right in your scope of work when you deliver it to the bank. But my fee is in that scope of work. In addition to when I refi, I get the delta out of there as well also. Let's keep going, guys. So I hope there was a little bit of some sauce. All right, here we go.
Just as much in this strategy as it does in any other form of real estate investing. Even if a property looks like a great deal, it still needs to be in an area where people want to live and rent. And strong rental demand, access to jobs, overall neighborhood stability all play a major role in the long-term success of being a great real estate investor. Financing the purchase can look different depending on your situation. Why? Because many investors do not rely on traditional mortgages for this step, especially when dealing with distressed properties. Some use cash, others turn to hard money loans or private lenders, and these types of loans are usually short-term and are designed specifically for investment projects. They often cover a large portion of the purchase price, even including funds for renovations.
Yes.
Even though speed is often important when securing a deal like this, it's still essential to do your due diligence.
Correct.
Inspections, title checks, and careful analysis should never be skipped. Unexpected repairs
on title checks, guys. Okay, listen to me, please, on this. Okay, on title checks, the title company is not working on your behalf. Let me say it again for the folk in the back row. The title company is not working for you when they're closing a transaction. Okay? Understand that. So make sure you double check their work too. That's why you have proper counsel on your side. So whatever they deliver to you, deliver to your counsel and have your counsel review everything for you. Okay? Understand that. Please do. I have been screwed over royally so many times because of bad title companies' work. Take it from me, okay? As maybe your de facto mentor. Please, please do this. All right, guys, let's keep going.
legal issues can quickly turn a good deal into a bad one. Planning for contingencies from the start helps you protect your investments and sets you up for a smoother process moving forward. Step number 2 is rehab. After purchasing the property, the next step is to renovate it. The goal is not to just make the property look better. The goal is to increase its overall worth and make it appealing to future tenants. A successful rehab focuses on improvements that provide the highest returns. Kitchens and bathroom are often key areas because they have a strong
kitchen and bathrooms are women's favorite places. So you got a woman, bride, right? Focus on these two areas. Go all out in the kitchen and and then the bathrooms. Go all out there. Because think about it, as you're walking through a house with your boo, right? What does she comment the most on? Man, look at the kitchen. Look at I like the backsplash, the granite countertop. She begins to describe what she's liking in the bathroom and the kitchen, right? Bedrooms are standard, right? So again, focus on these two areas in your renovations.
Impact on both property values and rental appeal. Flooring, paint, lighting, and exterior appearances also make a major difference. While it can
also the proper lighting, whether it be natural or can lights. Let me say can lights. Can light. If you know what if you don't know what a can lighting is, look it up. CAN lighting. Look it up. Very easy, guys. Right? That type of proper lighting can wow somebody to where someone may say yes, may say no because of bad lighting. The proper lighting will get them to a yes quickly. All right. As far as selling or leasing.
be tempting to add high-end finishes. It is usually better to keep things practical and durable. The property should be clean, it should be functional and attractive without going over budget. Planning is critical during this stage because before starting any work, you should have a clear budget and timeline in mind. Unexpected costs can arise and most certainly will, so building in a buffer helps prevent financial stress. Working with experienced and reliable contractors can make a huge difference in both quality and efficiency. If you choose to handle some of the work yourself, please make sure you have the skills and time to do so properly, or this will be a big project for you. Another important factor to consider is holding costs. While the property is being renovated, you may still be responsible for the loan payment, the property taxes, the insurance, the utilities. The longer the rehab takes, the more these costs add up. So staying on schedule helps protect your profit margins and keeps the project moving forward.
Right.
Plus, documentation is often overlooked, but it plays an important role later in the process. So please keep track of all expenses. Please keep track of all your receipts and take before and after photos. This can help support the increased value of the property during the refinance stage. It also makes things easier when it comes to taxes and financial tracking. A well-executed rehab not only boosts the property's value, but it also sets the stage for attracting quality tenants. And when done right, it reduces future maintenance issues and it creates a more stable investment overall.
Before we move on, I need to discuss something important. Every year you work.
So again, guys, I like what he's talking about there. Let me kind of give you guys a little bit more sauce real fast again. Give me fast on this section. Okay, I've never taught this before. All right, I've never taught this before because of the fact that the reason why is okay. Let me see how can make this make sense. So, this is okay. I can say this in this section when it comes to the rehab, which is probably to me the most important portion of this whole scenario. Real quickly, is this here? Is a good renovation, guys, will make or break you. Okay, it will make and break you if you don't get it done the right way, guys. What happens a lot of times, you will attract the wrong type of tenant, right? A lot of people, they don't like Section 8. I'm okay with Section 8 depending on the area, right? But a Section 8 tenant may not work in your geographical area. With the proper renovation, what happens is this here is you can maximize your refinance, right? I always say I use AI to prepare a appraisal package for the appraiser when I acquire the property and when I renovate and post renovation. Okay, I use AI. Don't trip. I do have something for you guys that you can download my exact prompts. Don't worry about it. I got you, baby. But I use AI to really prepare the appraiser for before and after renovation, because I was running into an issue when it came to appraisers. They were assuming their own intellect into the scenario, and that's a bad place to be in when it comes to appraisers. You want to make sure that there's no questions. They ain't assuming nothing. You give them all the data you actually have, and the good thing about it is you can actually have them include your presentation in their report, right? That's all I'm doing. And newsflash, guys, get this. You understand that appraisers now, they're using AI to complete a lot of their appraisals. Uh-oh. Do you see why I use AI? Because one of the licensed professionals that I'm leaning upon when it comes to appraisal value is using the same AI. Hello? So again, that's what I kind of do, guys. All right? I hope to help you out. Here's this, guys. Let's go back to my mans and them to finish this up. Here we go.
Self-sustaining for you. Setting the right rental price is so important. This requires researching the local market and understanding what similar properties are renting for in this area. We call that fair market value rent. Pricing the property too high can lead to longer vacancies. Pricing it too low can reduce your overall returns. The goal is to find a balance that attracts tenants while still covering all of your expenses and producing positive cash flow. Finding the right tenants is just as important as setting the right price, because a reliable tenant can make your life so much easier, while a problematic one can create significant stress and financial loss. Please take the time to screen applicants carefully. This often includes checking their credit history, verifying their income and employment, and also speaking with previous landlords. Once a tenant moves in, maintaining a good relationship becomes a priority. Clear communication and timely responses to maintenance issues can help keep tenants satisfied and reduce your turnover. Long-term tenants provide stability, and they reduce the costs associated with vacancies and frequent releasing. Consistent rental income is also important for the next step in the BRRRR process. Lenders typically want to see that the property is occupied and generating income before approving you for a refinance. So having a stable tenant in place will strengthen your position and increase your chances of securing favorable loan terms. Step number 4 in the BRRRR method is...
Now, I would say this here concerning this, guys, is this here. I get what he's saying about that, but some lenders, what they would typically do is they will, what they'll do is they will, either do, right now they're doing cancel refis without a tenant being in there, right? But I get what he's saying. If you want to maximize that refinance amount, rent it out first. Rent it out first. He's right about that. All right, let's get to it.
Refinance. The refinance stage is where the strategy truly comes together, because after the property has been renovated and rented, you apply for a new loan based on its updated value. This is usually done through a traditional lender offering long-term financing. The difference here is that the loan is based on the property's current appraisal, not what you originally purchased it for. This is where the money and the wealth happens. If the property has been improved effectively, this value should be significantly higher than what you initially invested. For example, imagine purchasing a property at a lower price and investing additional funds into renovations. After completing the work and renting it out, the property is now worth much more than the total amount you spent. And then when you refinance, the lender may offer a loan based on a percentage of this higher value. This allows you to pay off your short-term loan used during the purchase and rehab phase. And in many cases, this loan comes with a higher interest rate. And now you are refinancing, pulling money out, paying off that loan, establishing a new loan at much lower interest rates, giving you time to pull cash out of the refinance. It is what enables you to recover your initial investment. This process does require preparation. Lenders will review your financial situation first, and your credit history and your documentation related to the property. But having organized records and a clear understanding of your numbers can make this step so much smoother. Here's why it's important. When you secure favorable loan terms, it's important because these new loans will likely stay in place for many years. So a good interest rate and a manageable monthly payment can help ensure that the property continues to produce positive cash flow for you.
Now, I'll say this here, guys, real quickly. See this here. Here's some more sauce. Some more sauce. Lean in. I learned this from my brother off TikTok named Dwayne Williams. Okay? If you don't know who it is, follow him. Just go to my profile, look up Dwayne Williams, who I'm following. He's also following me too as well. And listen to their young brother. Well, he's not young. He's my age. But listen to him. There's a way for your personal credit history to even not be considered when it comes to refinancing in the BRRRR method. What you say, Doug? Yes. If you have the structure of a C Corp. Let that sink in. Now, they are going to want to pull someone's history, another person's history. That person is just not you. That person is your C Corp or your other C Corp. I'm trying to a C Corp, guys, right? Is, if you look up the IRS, and you'll learn this by watching Dwayne, okay? is considered a person, a literal person like you and I. Liddell Bucks is a person. You are a person. A C Corp is a person, not based on my definition, based on the IRS. Don't believe me? Go to the IRS.gov and go read it. Go read it. It's right there. Why, when you have an LLC, do they pull your personal credit? Because why? You're the personal guarantor for the limited liability corporation. The structure is limited. That's why it's called a limited liability company or corporation. Simple. And an LLC, guys, is a state structure, not a federal structure. You don't believe me? Go look it up. Go look it up. Don't take my word for it. Go look it up. But again, follow Dwayne. Dwayne, you know what? Nah. I'll do that next week. The proper structure for real estate. Gotcha. Not a problem. I may try to see if my man Dwayne come on. My man Dwayne. But yeah, this go follow that man. Dwayne Williams. He's on TikTok. Dwayne Williams. He talks about the power of C Corps. Okay? Again, not saying that LLCs are bad. They are great. I have LLCs. I do. But I'm about to convert mine over to C Corps. All because of what Dwayne had been teaching me. And it's not a one-on-one teaching I'm getting from Dwayne. It's been what I've been learning while watching it on TikTok. He gives away so much sauce. Dwayne Williams is his name. So not tomorrow, but next week I may do that. Now I may do a TikTok live later today on C Corps, right? And I may have Dwayne come on. I don't know. I'll see and see what's going on, and he can talk all about that. Dwayne is a monster. That's my dude. All right. So, anyways, guys, that's what's going on. Again, I favor C Corps now more efficiently than a LLC because a C Corp removes you completely personally out of the entire equation, and it focuses on the person of the C Corp, the person, not the person of Liddell, who's the PG for the LLC. It's the person of the C Corp, the person that is C Corp. The C Corp itself is the PG. Okay, you have a C Corp 1 that's acquiring a property. Another C Corp can actually be the PG. Because it may need a cosign, which is fine. No problem. Use another C Corp. Which is another person. Again, hey, look it up for yourself. Look it up. All right, let's keep going. Let's go.
At the end of this step, you ideally own a renovated income-producing property while also having access to the capital you originally invested. Now, step number 5 of the BRRRR method is to repeat. The final step is to take what you have learned and then do it all over again. This is where the long-term power of the BRRRR strategy becomes clear. By recovering your initial capital through refinancing, you can then use those funds to purchase another property and repeat the entire process over again. Over time, this creates a cycle of growth where each completed deal adds to your portfolio and then increases your income and builds your overall wealth. Success in this stage often comes down to systems and consistency. Boring systems that you are perfecting. As you complete more projects, it becomes more boring. You make more money, and then you start realizing this is how wealth is built. Boring things over and over again. Building a reliable team can also make a significant difference. Contractors, property managers, financial professionals all play a role in helping you scale. So please learn from each experience. It's essential. Not every deal will go perfectly, but each one provides valuable insights that can improve your approach moving forward.
He's correct. Not every deal would go perfect. I had to have one deal that went bad. It's because of me. I made a bad decision. And it cost me. Being fully transparent. Went bad. But I've had more deals go good than bad. So I'm not batting 1,000, right? And it came down to the general contracting relationship. It did not go well at all. So this is the power of, that's why 2 Fridays ago, Cliff and I talked about the importance of hiring the right general contractor. Whenever you go to a new market, make sure you hire the right contractor, right? Make sure you do that. If not, that can cost you a lot of money. A lot of money, right? So again, full transparency. I'm not Jesus. I make mistakes, but I'm rebounding very well off of it. So I'm not tripping at all. But again, that's so important. And also, write this down: a good bookkeeper and accountant. Okay. Now let me give you some sauce. An accountant is not a tax strategist. Okay. I'll say it again. A CPA is not a tax strategist. For instance, Carlton Dennis is not a CPA. He's a tax strategist or an enrollment agent, which is a term or a role that the IRS has given tax strategists. His whole thing is to look for what? Strategies for his clients to implement. That's why he's able to talk about these strategies. CPAs normally can't do that. They really they're really disciplined in bookkeeping in some form or fashion and preparing tax returns. That's it. That's it. Because there's so many things you can use in real estate. Cost segregation is one you can use. That's a strategy that I love. A CPA won't really know about that. Some will, some most likely will not. But a tax strategist like an EA would know what it is and how to get it accomplished. Does that make some sense, guys? That's why a team is so important. I may talk about your power team too. You should have a power team, right? Real estate is a team sport. It is not a solo sport. It's a team sport. Okay, let's keep it going.
Tracking your performance metrics and understanding what works best in your market allows you to make smarter decisions over time. With enough repetition, the strategy can lead to a sizable portfolio of rental properties, and each property contributes to your cash flow and your long-term financial stability, creating a really tough, strong foundation for future growth. Let's go over to BRRRR example right now. You purchased a distressed duplex for $200,000 in a strong rental area where similar renovated properties are worth more. So you start your rehab phase. You invest $40,000 into updating the property. You choose to update the flooring, you choose to update the paint, you choose to update the kitchen, the bathrooms. It increased the property's value and appeal. Now, you get ready to rent it. You rent out both units for $1,500 each, bringing in $3,000 per month in total rental income instead of the $800 that was being charged when you bought the property. Now you refinance. After repairs, the property appraises for $300,000. A lender offers you a new loan at 80% of the value, $240K, allowing you to pay off the original loan and recover most of your cash. Then you go repeat. You use the money you just pulled out to buy another property and run the same process over again, building your portfolio. This is how.
Now let's go back real fast. Look at the numbers. You see the numbers real fast. Look at these numbers. You see them. This is what I want you to look at. See, total all in 240. Yes, you had the monthly cash flow $3,000 a month, right? Right, which is the gross. Now get this, right? $300,000 appraisal, 240, 80%. Now he says 80%. That's rate and term. Okay, that's a rate and term refinance. It's not a cash out, guys. That's rate and term. Okay? What the rate term means is that you pull out no cash at all, right? All they do is refinance out and it pays for your closing costs, right? Which is fine, which is good. Then what happens is this here. You then turn around and you get a lower rate and a longer term. Rate and term refinance. That's all that means. That's all it is. Make sense? It's all it is. Just saying. Now, this is the reason why I was saying this here, right? The reason why I'm saying this here, guys. The reason why I'm saying this here, guys, is because of the fact that, do you see the reason why I like to have a 5 to 10% delta in my renovation budget? Because on this example, yes, I get my cash back, great, but I ain't made no profit. I just finished even. I got to wait for 30 to 60 days before I can even get some additional capital coming in as far as cash flow. But if I did this exact same example and I had that 5 or 10% arbitrage or delta and was going to work, I've actually made, let's look at the numbers real quickly, guys, right? If the renovation is $40,000, right? The renovation is $40,000. If it's 10%, that's $40,000. That's $4,000. What I've done is I've made $4,000. So my renovation was really $36,000. but I collected 40,000 in draws. So I pocketed that 4,000. That paid me for my time. Make sense? Now, if you really want to be sexy with it, I like to put at least 10, if I can, in my pocket. 10. Between 8 and 10. Because why? That's my time was worth that time. Right? But think about it. If you did this type of scenario 4 times a year, right? The BRRRR Method 4 times a year, right? And that's without you taking any cash back at all. And I'll get to that in a second. And you're pocketing in the delta there. Let's just say in this example, $4,000. You did it 4 times a year. That's 20 grand you made. 20 grand. And get this, it's not income, it's debt. What depends on how you structure it, but still, what I'm saying is this is why I put a 10% delta in the scope of work, so that I actually get paid while the renovation is going on. But typically, these numbers are great generically, but typically I refinance at 75% because I want to cash out. So I'm all in at about 65%, 70 tops. So that 5% I can take home myself. So if I had 5% here, guys, 5% of that, if I, and let's say for hypothetically that's an additional 7 grand. So I've netted 4,000 on the renovation budget, another 7,000 on the refi. Both are non-taxable. If it's structured the right way, I've made $11,000 for a project. I still have the asset on my balance sheet, and I'm making $3,000 a month gross. Most likely net, I probably net in probably around like $1,500 a month. It's not bad, is it? 11 grand of non-taxable profit, and then $1,500 a month in positive cash flow. Net. Do the math. It's not hard, guys. The secret is you have to purchase right. You got to buy right. You cannot buy terrible. This is the reason why when it comes to this for me, this is the reason why high rates don't scare me. Interest rates, because of the fact that means I get more aggressive on buying a property, right? On the purchase price. It doesn't at all stress me out at all. I welcome high rates because that means I get a lower price point. Because if it costs me more interest rate wise to buy said property from said seller, hey, I gotta really plan for that pressure there. So therefore, I have to have a lower purchase price. Does that make sense, guys? I'm a negotiating hawk when it happens. That's good stewardship. I'm a Bible-believing kingdom citizen, right? Believing in Christ. If God is entrusting me with this business model, I better be a good negotiator because I have to buy the right way so that I steward the process the right way so that I can maximize the ROI and I can get the proper housing to the proper kingdom citizen, right? Or someone that needs housing at a good rental rate. And get this, guys, I like doing lease to owns. Okay, I do lease at my apartment complexes. I do per unit. I do. But when I'm doing the SFR, single family residence, I like lease to own scenarios. Can I tell you why? I'm looking for a long-term leasing partner, tenant, right? That's looking to place their roots there, right? Which is great. With it being a higher interest rate economy, I must rather do a 24 to 36 month lease structured the right way, right? And at the end of 36 month time frame, I can charge a higher monthly payment because they are taking care of the property for me. They're maintaining the property. All that is on them because it's a lease to own or lease purchase scenario, right? At the end of the 36 month, the 24 month time frame, they can refinance me out of that mortgage. Or I could just convert that lease over to a promissory note. It says on my balance sheet, right? and all responsibility goes over to the now buyer of the property with the promise to know from me, right? They take care of insurance, they take care of maintenance, they take care of everything. But I keep the asset on my balance sheet. And get this, guys, if the rates go up higher, guess who actually can offer a low interest rate? Me. I can now compete with the banks. Again, it's strategy. Strategy. Don't think off just one deal. Think of off 8 deals, 10 deals. Because if you do this right, guys, you can pocket $10,000+ per deal and net a good amount of money, cash flow per deal. 11,000 times 4 years is 44 grand. It's somebody's salary that you've made in non-taxable income, and you've cash flowed $1,500 a pop. So at 4, that's $6 grand a month in positive cash flow. Hello, McFly. This is for a duplex. This is for duplex. These are duplex numbers. Hello, McFly. Because typically, in a duplex, 1 unit can pay for the entire mortgage. So the second unit is 100% cash flow. Yes, sir. Yeah. I hope I get y'all some game today, guys. I hope I did, man. I love real estate, guys. Real estate for me has provided a great income for me and my family. You do have ups and down days, but it's a part of business. It's like life. But again, guys, this BRRRR method, guys, right here is phenomenal. Buy, rehab, rent, refinance, and repeat. Very simple. All right, guys. Well, guys, that's all I have for today, man. I hope I added some value today to you guys. Now, very quickly, if you are wanting to download our free distressed property ebook, guys, how to locate and buy your first or of many distressed properties in your city, county, and state, how to buy it right. It's very simple. You can click on the link below in the show notes, depending on what platform you're on. Scan on the QR code right there, fill out a quick survey right there, which is pretty good, and go download it. It's very simple. Or DM me the word real estate, and my team will get you out the link immediately. Now, we are going to set up, guys, something that we call real quickly. I'm going to go here real fast. Do I have it? We are setting this up here real fast, guys. All right. We're setting up a cash flow club real estate community. That's in the works right now, to where we have a community that can come together, whether it be in real estate, financial services, network marketing, new construction, private equity, and we can talk about deals, exchange deals, partner up on deals, right? Cliff and I will be kind of the point guards on this thing. And what we'll do is we'll bring in professionals, CPAs, accountants, tax strategists, attorneys, aspect attorneys, wealth strategists, things of that nature. And they can teach you some things about how to get it done the right way. And if you have a deal and you need a partner, they can be located in this cash flow club community, guys. It's right there, guys. And if you're looking to buy a business, we're looking to get that set up as well also, man. So that's in the works right now. And we have a tool that our cash flow club members are going to be the first one to get access to, that's going to change the game in real estate to where you'll be able to vet a property with your phone immediately in seconds. It's coming. It's coming. It's in the development stage right now, guys. All right, guys. Let's see. Anything else we got? Lastly, you may not like real estate. That's fine. There's a term called digital banking, right? We talked about it today on the podcast, guys. Digital banking is here. You know, companies like Stripe, SoFi, Chime. Those are fintech digital banks, guys. The average American swipes their debit or credit card 30 times a month. Each time there's a swipe, guys, what happens is this here is there is a a processing fee paid each and every time a card is actually swiped. Here's my question to you: what if you could actually what if you were making a nickel? A nickel. Let me say it again: a nickel per swipe. Do the math. I multiply that in American times 10. 100, 1,000. Do you see how digital banking it's here? All right, guys. If you want to know information about digital banking, guys, and how I can maybe help you out, don't you worry. We got you. DM me the word mentor. Click on the link below. All right, which is fine in the show notes. Or you can also see on the QR code. Once you email me the word mentor, we'll get you out the link. It's free information. It's free. All right, guys. But guys, thank you so much for your time. God bless you. I hope you guys have a phenomenal weekend. Hey, man, enjoy the World Cup. I have been watching the World Cup, man, and I ain't gonna lie to you, I've been enjoying the World Cup, y'all. I have been enjoying the World Cup. Oh, and one last question, guys. One last thing. Next week, we're gonna get back on this segment. This is a new segment every week, guys. Here we go. Network hustle. We have a section, guys, called Protecting the Bag. Each week, we're going to go through that. I had one just right now with the BRRRR Method. Didn't play it, so he's right there, guys. But, man, I hope I gave you guys some value. I may come back live just on TikTok, guys, and I may just teach directly just on the BRRRR Method a little bit even more deeper. Because I can get into the bag more there. And I can show you an actual deal that I actually did with Cliff. And we made money on the renovation, on the purchase, and on the exit. And it was a nice amount of coin. 6 figures. Multiple. So just not bragging, but it can get done. But anyways, guys, thank you so much for your time. God bless you. I got to go. You know, every time I always say that you are one deal away from changing your life, guys. Now, take the picture for your mama and them. Holla at your partner. God bless you guys. See you guys next week. All right, y'all. Peace. What's good, guys? It's your partner Dale here, man. Hey, I always say that when it comes to real estate, I think this is the best time. The next 3 to 5 years is the best time, in my opinion, to begin to invest in real estate. Whether you are a seasoned investor or a novice investor, this is the best time, in my opinion, to invest in real estate. Now, why would I say that? It's very simple. Whenever there is some stagnation within the real estate industry, that's the best time to get deals, right? Deals are what attract the capital, right? A good deal will always attract good capital. Now, what's a good deal? Well, I like buying distressed properties below wholesale. The skill to buying right is learning how to locate distressed properties in your city, county, or state. Now, the good thing about it is we are giving away a free ebook called Distressed Property Investing. We talk about different ways of locating distressed properties in your city, county, or state, what to look for, who to call, things of that nature. It is free. Once you master this type of skill of locating distressed properties, you'll never be broke ever again, because good deals attract the right capital. All right, guys? So to get the free ebook, click on the link below, scan on the QR code here on the screen, or you can DM us the word real estate and my team will get you out this free ebook. Again, it's completely free. Just want to get you this information so you can begin to get the bag while buying real estate. Stay blessed and holla at your partner.
Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Big God, big grace.
Okay, so you did fixes and flips first, or were they? Now it sounds like you're more buying whole. Okay, so you're wholesaling first. Okay,
because I was broke. I had no credit, I had no money, so I had to get some money coming in. So I learned how to do wholesale.
And you were doing wholesaling at the good time too. 2000. When it wasn't so saturated. There was.
I kind of saw the debacle coming. Okay, it didn't make any sense. I was like, wait a minute, how can you lend out to retail buyers 99.7%?
Yeah,
just a little bit of a down tick. It's insolvent.
And you got to remember, in some states, because I lived in Florida at the time, you could have loan to value above 100% of your property.
Right.
The first property that I bought, it was 110%. We left the bank with like $30,000.
Yes.
Yeah.
Yes.
It was amazing to me. I was like, why am I not doing this all the time? But then clearly 08, 09 let me know why people shouldn't have been doing that all the time.
08, 09, that's why I made that lion's share of my money.
Wow,
People
okay.
were actually running from the cows. I was running to it.
Of course.
Because I saw it was coming.
Okay.
A lot of my business colleagues back then were buying flippers.
Yeah.
I didn't think it was wise for me to share 50% of my profit with Uncle Sam. He didn't do no work.
Okay.
So why would I give him free money?
Of course.
Okay, how can I make sure I'm still legal, but keep the lion's share of the cash flow?
Of course.
So I began studying the tax code with my accountants and CPAs, and I said, okay, I'm going to buy a whole lot of properties. Now watch this. I actually buy a lot of properties. And I take home money when I actually acquire it. Every single time.
Okay, you need to break that down just a little bit.
If you'd like to learn how successful real estate investors make money when they acquire real estate and not when they sell it, click on the link below, swipe up, DM me the word to real estate to download our free ebook, Distressed Property Investing. The blueprint is in the ebook. Stay blessed. I'll let your partner and download the ebook today.